Good evening, everyone. Welcome to our Riverside Alumni Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. Thanks so much for taking time out of your busy schedules. I know it's a Thursday night, probably other exciting things you'd like to be doing, but I'm glad you got a chance to spend a little bit of time here with us this evening to dive into the path towards homeownership. So this is an hour-long class, but we try to weave in a lot of great tools and resources to help you along the journey of homeownership. And this is a very interactive session. So as we go through tonight's class, we encourage you to ask questions of us. You can use the chat feature in Zoom or Q&A. I have both windows up on my screen. I'll be kind of monitoring those as we go throughout the night. I'm really excited to bring this content to you. Lots of stuff going on these days. And, as we're kind of preparing for the end of year of 2025, it's hard to believe that the year's almost to an end. I think as you're thinking about making a decision like home buying, it's great to be a part of a class like this so you can understand a little bit more about what it could look like for you. Now, we get a chance to teach classes just like this 4 times a year. And so they're offered to you through the UC Riverside Alumni Association. And so, if you enjoyed tonight's class, which I hope you do, you can be able to get a chance to look back at this class because we're actually going to be recording tonight's class. And I'm going to share with you all of our presentation material. We'd also encourage you to share this with your friends, family, maybe some coworkers that might also be thinking about home buying or just want to kind of get a little bit more knowledge about what's out there in the market. Well, my name is Jason Maida. I'm going to be your presenter tonight, and I work for an organization called APM. We're one of the 9th largest mortgage lenders in the country. Our team specifically teaches educational classes like this all across the country to help support our communities in affordable homeownership so you can understand really what's available to you as a future first-time buyer. So we've taught well over 10,000, or we actually will have over 10,000 people sign up for classes across 2025. And this is something we're really passionate about serving in homeownership. Now, here's our talking points for this evening. We're going to spend some time looking at a rent versus buying exercise. I'm going to walk you through a calculator to understand a little bit about the comparisons of continuing to rent versus buying. I do want to also spend some time talking a little bit about the housing market, what's happening there. A lot to talk about there, even though we're in October, in the fall season, there's some stuff really happening in the housing market, especially around interest rates. So we're going to spend some time looking at where we're at today in interest rates, kind of where do we think we're going, especially with a lot of the economic news that is coming out as of late. And then we're going to kind of move from there and talk a little bit about credit and give you some tips and some resources around credit to understand a little bit more about how we view credit from the lending perspective and maybe some areas of opportunity for you with your credit score. And then we'll talk a little bit about loan programs. We're going to talk about savings for home ownership, dive into some first-time home buyer programs. And then one of the more important things we're going to talk about tonight is, where do I go from here? After tonight's class, you may be interested in building your own home buying plan. So I'm going to walk you through the workflow of buying a home. So after tonight's class, where do I go from here? How do I get connected with you to be able to help kind of put a plan together and then start that path towards home ownership? So let's go ahead and dive in. I know we got some folks arriving a little bit late. In case you just missed it, we are recording tonight's class, so you didn't miss anything. And we'll have that up on our YouTube channel. You can check it out a little bit later, and we're also sharing back our presentation material. And again, I encourage you to ask questions of me in the chat or the Q&A feature within Zoom. And so we'll go ahead and get started now. And so as we kind of think a little bit about buying, it is probably going to be one of the largest decisions we decide to make financially, right? So this is a huge milestone for many of us in home ownership. And what comes along with that is a lot of great benefits with home ownership. One is I'm now going to be able to control what my housing expense looks like on a monthly basis. Now, when I'm a renter, I'm at the mercy of a landlord that could potentially lift the cost of my rent, right? But not with homeownership. We actually control that expense. And some of our clients that are choosing to purchase in today's market will probably have the opportunity to refinance down the road. So when rates start to normalize a little bit, they'll look to refinance to help improve their cash flow or overall lower their monthly payment. And this is an asset that can grow over time. So as I purchase my home, that home goes up in value. As I continue to pay down my mortgage, that is going to create home equity. And for most of us that are homeowners across the country, that's our number one asset that we have, maybe next to 401ks or any type of retirement accounts. The home equity is going to be the biggest pieces to the puzzle for us in really wealth. And there's also some really great tax benefits that come along with owning a home, potential tax deductibility of interest. When I make energy efficient upgrades to my home, potential tax benefits there as well. That's one of the things I always encourage clients to think about. And, because when we think about home ownership and the budget we have around that, it's probably not going to look the same in renting. And way we can illustrate that for you is to look a little bit closer at a rent versus buying calculator. And you're going to hear me talk tonight a little bit about consultations that I do with clients in building their home buying plans. This is one of the tools that we call upon to help really kind of understand a little bit more about home ownership, because it's not really like an apples to apples comparison. So if I'm paying $2,500 in rent, that doesn't really equate to $2,500 in mortgage expense. And so a tool like this can really be super useful for you to be able to really understand a little bit more about your benefits in home ownership. So in our classes, we always like to kind of walk our class through this calculator. And like I said, during a consultation, I do the same thing with our clients. But this has an example here, and I'll walk you through kind of what this looks like. But ultimately, if we had someone that's paying, let's say, $600,000 for their home, or that's their projected sales price, they're going to put down 3% to buy their home and finance 97% of that purchase price. So that's $582,000 at today's average interest rates over a 30-year fixed time. That is going to give us a monthly payment. Now, we're going to talk more about loan programs tonight, but you'll learn later on that when I put less than 20% down to buy a home, there's a thing that is called mortgage insurance that comes into play. And so we have that baked into our calculation along with homeowners insurance, tax expenses, or property taxes, I should say. If I'm choosing to purchase maybe in a community like a homeowners association community that's like a condominium, maybe a townhouse, I might have HOA dues here, all right? And then we also want to factor into homeownership tax benefits, right? So what tax bracket am I in today? What are some of the costs that I'm going to have in maintenance to my home? When I eventually decide to sell my home, how much of the cost is going to be to selling my home? And the appreciation rate of my home. So in most of our scenarios, we factor in a 3% appreciation. Of course, it does depend on where you're going to purchase in the country, but 3% is kind of a nominal number. And then in this scenario, we have someone that's paying $3,000 a month in rent and with an expectation that their rent will increase 2% on an annualized basis. So what our calculator essentially tells us is that if I was to buy a home for $600,000 today and stop renting, the benefit, or I should say the break-even point of renting versus buying is about 3 years. So that means based upon my investment of down payment, and when I factor in home appreciation, tax benefits that come along with owning a home, my break-even point's about 3 years in owning versus renting. Now let's look a little bit further out. What if I own my home for 10 years versus I deciding to rent for 10 years? Now I have a bigger opportunity. Now my gain opportunity is $164,000 by owning a home versus renting. And I think that's the thing that we have to consider as a class. As we consider home ownership, the opportunity that comes along with not only having an asset, but an asset that works for us is a real critical piece in the element of buying a home or owning a home. Because as I mentioned, for most of us who are homeowners, that's our number one piece of equity or number one asset that we have in that home equity. Now, I would encourage our class, because we are going to pass along these tools to you, run your own calculator for yourself. I think you'll find that to be a really great exercise. And of course, as we meet with you for your one-on-one consultation, we'd love to be able to help you out with that as well. All right, now let's pivot a little bit. Let's talk a little bit about the housing market. Lots going in the housing market right now. We're in an interesting time right now with the housing market because we're seeing homes stay on the market a little bit longer. Supply is starting to stack up. You can see in the Riverside market, and I know we're joining from different parts of the country and the state, but if we're looking specifically at the Riverside market, it looks very similar to other Southern California markets. A little bit more inventory staying on market, longer period of time. You can see median days on market, 63 days. You're seeing a little bit of a trend down in prices. That is attributed to some of the backlog of supply. You're seeing a lot more sellers that are making what he calls concessions in the transaction. So meaning sellers are either cutting price or they're providing credits to the buyer to help with some of their closing costs. So in some markets, like we can see in our data points here, it is a buyer's market. And so that makes things a lot more favorable for our buyers. And it is a very active market, not just in the Riverside market, but all across California and some of our other kind of national markets right now. We're seeing a lot more buyer activity pick up. namely because interest rates are starting to cooperate. We're starting to see interest rates start to move a little bit lower. We've had a little bit of a choppy road ever since 3 weeks ago, as of yesterday, when the Federal Reserve cut interest rates by 0.25%. Interest rates have kind of bumped around a little bit, but just 3 weeks ago, we hit our 12-month low in interest rates. So that is a really encouraging sign. That's bringing more buyers to the market. I think as we look at today's interest rate, it's about 6.25, give or take the loan structure, but that's kind of where we're at. We're really watching carefully to see what the Federal Reserve does for their next move. There are some that are assuming that the Feds will cut rates another 2 times this year because there's 2 more Federal Reserve meetings left in 2025. But guess what? There's a government shutdown going on right now. So we're not getting the data that we would normally get in the financial markets. So there's a little bit of a standstill right now. So some, important like labor reports that come out and kind of will help move the markets up or down. We're not getting access to that right now because it's not available. So, hopefully we'll see the federal government start to get to restart. We'll start to get kind of a normal flow that we see in the economic markets, but we just don't have a lot of data right now because the Federal Reserve's decision making is going to really come from what's going on with inflation in the markets, but also what's happening in the labor markets. So if they're softening in the markets, we're probably going to see them make the move and make some cuts on interest rates, which will be certainly a welcome sign in the housing market. Now, when we look at mortgage interest rates, the mortgage interest rates don't go lower when the Federal Reserve makes that announcement. It's already kind of presumed they're going to make that move. So if you look at rates leading up to the Federal Reserve announcement 3 weeks ago, rates had already declined in the mortgage space. And so they've actually increased since they've made that decision, but that's more attributed to other factors in the market. But ultimately, kind of as we should know as a class and future buyers, is that rates are going lower. The question we have to ask ourselves is, what's that going to do for buyer activity? Because there will be more competition in the market, even though we're seeing some markets that is a buyer's market. So as we look at this slide, we can see the kind of rate activity over the last 12 months. Also want to share with you the last 20 years of interest rates because I think it's important to frame that up. Just like the housing market cycles, interest rate cycle as well. Now we happen to be coming out of a high interest rate cycle. We're still at that low 6s, but it wasn't too long ago that we're in the high 7s. And here's the last 20 years of look back. Now, these gray bars represent economic crises. You can see the housing market. You can see, obviously, the pandemic here. And then, interest rates out of the pandemic were at 2.5% interest rates. And I think as future buyers, it's important to understand that rates are probably never going to cycle that low again unless something catastrophic has happened globally. But average interest rates are generally in the high 4s to low 5s. That's generally what we see. I think what we'll see probably next year is, rates, depending on what the Federal Reserve does with rates, we'll probably see rates tick down a little bit lower entering the end of 25. We'll eventually see probably interest rates maybe 0.5% lower in 2026. Now, all interest rates aren't the same for all buyers. So I think that's important to understand because interest rates have different characteristics that go into them. Things like credit score and the eligibility for a product, what your loan program is that you're selecting, how much you're going to finance, what your down payment looks like. And you do have an option as a buyer to pay additional funds out of pocket. We call those discount points in order to bring down your interest rate. Usually one discount point is the equivalent of 1% of your loan amount, and it will generally drop your interest rate about 0.25%. All right. Now, in today's market where interest rates are trending lower, we don't recommend clients paying those points because that unfortunately has a very long break-even period. So it usually takes about 3 to 4 years to break even on those types of investments. Now, term of my loan can also influence interest rates. So the shorter my term is of my mortgage, generally that will reduce down the cost of my interest rate. Now, as we get a chance to meet with clients and design their own home buying plan, we're going to figure out what the right design looks like for you, what those interest rate options look like, because it will vary based upon credit score, down payment, and like I said, how much we decide to finance and the type of product we're selecting. Now, one of the bigger characteristics that makes up interest rate is other components, as well as other components of financing, is credit. And so in our classes, we like to dive in a little bit deeper into credit to help give you a better understanding of how we view things from the credit perspective in the mortgage world and give you just kind of some guidelines on improvement opportunities for your own personal credit score. Now, every loan program has a minimum credit score requirement, and we can have those see those highlighted here on screen. So some of our California specific programs for first time buyers, like the CalHFA program, like some of us in class might be interested in, you can see the minimum credit scores, as well as some of the more kind of traditional programs are listed there. Now, when we look at credit scores as a lender, we're going to look at all three credit agencies. And those credit agencies are TransUnion, Experian, and Equifax. And we always take the middle credit score of all three agencies. So if my highest score is 740, let's say my middle score is 720, and my lowest score is 700. We're going to take the middle score of those three agencies reporting. So in this scenario, my middle score is 720. Now, if I'm going to apply with my partner, let's say my partner scores are 700, 680, and 660. Well, my partner score's middle score is 680, which is the lowest between the two of us. That 680 score would be what would be used for qualifying purposes. So as I get a chance to work with clients on their home buying plan, we're going to figure out how to best construct their financing. I mean, maybe it makes sense to have only one of those applicants on the application to qualify versus two if, of course, if they can qualify with only one person's information. All right. Now, when we look at events on credit reports like late payments, maybe collection accounts, some of the bigger items that impact credit scores from a negative perspective, that impact to the score is going to be generally in the most recent 12 to 24 months from the date that event hits the credit score. So we'll take a look at some of the weighting of credit scoring as it relates to the mortgage model. Now, speaking of models, there are three different models to credit scoring. There's the credit card model, there's auto financing, and then there's a mortgage model. Now, when you apply, of course, for home financing, we're going to use the mortgage model. Many of you that have monitoring services like Credit Karma or some of the different tools that are out there, they're going to use a credit card model for your credit score. So oftentimes when clients will reach out to me to talk about their credit, they say, hey, Jason, Credit Karma says I'm at 780. I'm not really understanding why the mortgage score is 760. And the difference is because there's different risk models between both the credit card and the mortgage model. So that's why I might have some variance between the two scores. I'll take our class through the weighting or what goes into the mortgage score in just a few minutes. Before we do that, I want to talk a little bit about negative items and how long they'll stay on your credit report. So this gives you a matrix to show you how long they'll stay on your credit report. Now, negative items will show up in terms of the impact to the credit score in the most recent 12 to 24 months, but this is how long they're actually going to appear on the credit report. So let's say, for example, I had a late payment on a student loan back in October of 24. Now I'm still inside of that 24-month window, right? And so I'm actually still, at right around 12 months. So I'm probably feeling the effects of that late payment on my credit score. But as I get further away from that event, the improvement I'm going to start to see in my credit score. Now, this slide kind of shows us a little bit about the mortgage score calculation. So this shows you kind of like where that's weighted. And as you look at the kind of the sections around the wheel, you as a buyer or someone that's viewing their credit profile can look at one of those areas of opportunity. So as we go along the wheel, we can see, length of credit is 15% of the weighting. That's going to be how long I've had a credit profile. So, if I've had a credit profile for 6 months versus another buyer that's had a profile for 6 years, someone with more seasoned credit, assuming everything else is equal, is probably going to have the higher credit score. Now, going around the wheel, we have the 20% component, which is how much new credit am I trying to access? So meaning if I'm opening up a lot of different accounts, I'm having creditors inquire on my credit, probably negatively impacting my credit score. So just actually earlier today, I was working with one of our clients, and this is someone that has on-time payment history, but we couldn't quite identify why his credit score wasn't hitting the levels it should be. And when we looked a little bit closer, is because he had opened up a few accounts or 3 different accounts in the last 12 months. Because of that new credit openings, that impacted the credit score. And as you can see, it's 20% of the overall weighting. Now, as it relates to inquiries, this is important to know, is that most lenders, when you apply for mortgages, are going to do what we call as a hard inquiry, which can negatively impact your credit score. So you want to be mindful of that. Now, there are rules in place that allow you to apply with as many mortgage lenders as you like in a 30-day window of time. And it's the equivalent of 1 credit inquiry hit to your score. Now, our process is a little bit different with our team here at APM because we actually only do a soft credit check. And the reason why we choose to do that is because, especially for our first-time buyers that attend classes like this, may not be ready to buy a home right away, right? And so we want to provide you a comprehensive plan in home ownership without necessarily impacting your credit score. And that's where I think the soft credit score can be so much more effective for you. And then 30% is going to be, and this, by the way, is probably the biggest area of opportunity for most of our attendees to our classes. It's around credit utilization, managing revolving debt versus what the credit limit looks like. And so it looks like this. So if I have an example, let's say $10,000 in credit limits, and my balances are $7,000 in revolving balances, right? That means I'm at 70% utilization. So that's probably negatively impacting my credit score. Our first step for a scenario like that would be, let's try to push that utilization down to 50%, which would mean a $5,000 balance or a reduction of $2,000 in my outstanding credit card balances. So that would start to give us a little bit of lift in our credit score. Then we would want to work towards $3,000 in balances or 30%. And then optimal is going to be 10% utilization or better. So $1,000 or less. That's where you're going to see yourself at the 800 plus credit score levels. Now, here's my tip for you in managing utilization on credit, revolving credit. So if you take a look at one of your credit card statements, there's actually two dates that are really important. One is your due date, which we all know about. But the other date that kind of people just overlook a little bit is the statement date or activity date. What that is, that's the activity for your credit card in the previous 30 days. And what happens is, on the statement date, the credit card issuer sends all that information out to the bureaus. You know, what your balance is, how you've paid, what your credit limit is. So my tip for class is, if you can pay down those accounts or whatever number of accounts you have before the closeout of that statement date, you're going to get a much lower balance that reports out to the credit agencies, therefore lowering utilization and, of course, improving your credit score. So that's just a better way of managing credit card debt. And then the last component is going to be payment history. How have I paid my bills? So we're looking really at that 12 to 24 month history. And if I have a late payment, it's rated as 30-day lates, 60-day lates, and then 90+ day delinquencies. So the more severe my late payment is, the bigger impact I'm going to have to my credit score. All right, now kind of sticking with the theme of credit, I want to talk a little bit about student loans. And because student loans are part of the equation in reviewing our home buying plan for our clients. And there's a couple different ways we look at student loans. If you're in an active repayment on a student loan right now, let's say you're in a savings plan or like an income-based repayment program, we can utilize that lower payment for qualifying purposes. So let's say I have $75,000 in student loan debt. My savings plan is at $250 per month. Then we can use that $250 payment for qualifying purposes. Now, I have to be in active repayment for that to happen and use that amount. So I still have clients that are still not in active repayment. So in that scenario, when we don't have an active repayment, like in forbearance or deferment, that if we're going to do a conventional loan and we still have that $75,000 in debt, we have to take 1% of the balance and use that as the monthly payment. If it's an FHA loan, then we take the same $75,000, but we use 0.5% of the balance, which of course would be $375 per month. So we're going to kind of work with our clients on student loan debt. But I think the important takeaway here is, if you're going to be in a savings plan or income-based repayment, we got to make sure it's actively paying right now. And if you're in forbearance or deferment, we have to count some minimum payment when it comes to qualifying. All right. I'm going to take a quick pause there. I know I've given you guys a lot of content so far, but any questions so far on any of the material we've covered at this point? I know we've had some folks join us late, and thanks for showing up for our class. We appreciate it. But again, you can ask me any questions in the chat or the Q&A feature, and I'll make sure I get those on air here. Okay, if we don't have any questions, we're going to keep it moving. Let's talk a little bit about loan programs. A lot of what we ask for on the student loan side is a result of some of the guidelines in loan programs. So here's a look at 5 loan programs. I'm going to give you kind of a 10,000 foot view at each one of these programs. The first one is a conventional loan, which is Fannie Mae and Freddie Mac. You might have seen Fannie and Freddie in the news more so now because there's talk about taking them private and you know the effects of that on the housing market. But ultimately, Fannie and Freddie have guidelines to lending. So for a Fannie Mae or Freddie Mac loan, as a first-time buyer, the minimum down payment is 3% of the purchase price. You can see the minimum credit score on screen. And then we have what we call as a conforming loan limit, which is the maximum loan that they will allow under these products However, if you're going to buy in a high cost of living market, let's say you're going to purchase in LA County, we can go up to 1.209 million. But with that increase over the conforming limit, the minimum down payment jumps from 3% to 5%. The FHA loan is a government insured loan. That's 3.5% minimum down payment. And then the maximum loan amount will vary based upon the county that I'm going to purchase in. So San Bernardino County's limit's going to look a little bit different than, say, LA County, for example. The 3.5% down payment mark stays the same regardless of what county I'm purchasing in. Now, FHA is going to have a little bit more flexibility and guidelines with qualifying around credit, maybe past late payment challenges that I've had, as opposed to the conventional product. Now, both the FHA and just below here is the USDA product. Now, these are both government insured products. Now, there was some changes to the eligibility guidelines for these products about 4 months ago now, as it relates to resident history. So you do have to be a permanent resident to access both of those government insured products. Unfortunately, those changes were made with those product sets. Now, with a conventional loan, you can still be a non-permanent resident and still access Fannie Mae and Freddie Mac products. So speaking of the USDA product just below here, that is a zero down payment option. And it's designed to support clients that are going to purchase in more rural areas. There's 2 qualifiers for that product. It has to be a designed rural area or designated rural area. And we also look at the income by household. And then on the jumbo loan side, that's more of a product that clients are going to need a little bit more buying power that stretches beyond, say, the Fannie Mae or Freddie Mac capabilities. It does have higher down payment options or requirements, and there's going to be higher credit score requirements. We don't see that a lot for first-time buyers, but it's certainly an option for you. And then for our veterans that have eligibility in the VA home loan, that is a zero down payment option, 620 credit score. And then there really is no maximum loan amount for our veterans. As long as they have eligibility, we can lend up to as high as $5 million as a zero down payment option. Just a great product to have entry to home ownership for our veterans. All right, so that's kind of a look at some of the kind of the core loan programs. I want to spend some time talking a little bit about mortgage insurance. We got a lot of conversation going around mortgage insurance with clients. Before I do, I did have a question that popped in the chat, which is how, and this is gonna be a tough one, but how can we predict the housing market, whether it will continue to dip or rise? Also, how can we predict which cities will rise in home value to purchase at the right time? So, that is a tough one. In the world we have today, it's very tough to predict kind of what's happening in the housing market. We are starting to see, as you saw in my slide earlier in the housing market, some softening in some markets with excess supply coming on. I think, all buyers want the perfect storm, right? We want the lowest priced home. We want the lowest interest rates. Probably not going to get that. Just ask those that tried to purchase back during the pandemic. It's very difficult to do. I think we're just have to watch what the housing market does. I mean, our indicators don't show a decrease in housing happening anytime soon. We still have supply issues. And so if you look at inventory levels, even though it's kind of stacking up a little bit, in most parts of the country, we don't have enough supply and builders can't build quick enough, especially with the cost of building. And, buyer demand is coming back with lower interest rates. So, I don't see projections of housing costs going lower. I think, we are going to recalibrate a little bit, certainly as interest rates go down. But, I think as you consider when you get into the market, I think it's going to be important to have conversations like kind of what we're having tonight, but in a one-on-one setting to figure out what your goals and your objectives look like for homeownership. All right, hopefully that's helpful for you. Let's talk a little bit about PMI. So PMI stands for private mortgage insurance, which would be under conventional loans. And then we have FHA mortgage insurance, which is MIP. Now, ultimately what mortgage insurance does is it insures the lender against default by the buyer. So if a buyer unfortunately was unable to make their payments, the lender is protected against that. And that is paid for by the buyer of the home. And on a conventional mortgage insurance is set up with, or not set up, it's calculated based upon down payment, credit score, and based upon the amount financed. Okay, so those 3 elements go into the risk factors, if you will, for PMI. Now, PMI on a conventional loan does have a cancellation option that when you reach 2 years to 2 years in the home and 20 to 22% equity, you can apply to have the mortgage insurance canceled. So the higher I can push my credit score, though, the more I can put down, the lesser cost I'm ultimately going to have with private mortgage insurance. So let's take a look at an example here. You can see we have an amount financed of 500,000. We have credit score listed as 740 and someone that's putting 3% down. That's about $154 a month. Now, for those of us in class that have started some of our search on Redfin, maybe Zillow, have used some of their calculators, those PMI numbers look a lot different because they're not calibrated based upon kind of what I've shared with you earlier. All right, let's go over to the FHA side of things. Now, FHA has two forms of mortgage insurance. There's mortgage insurance premium, which is monthly, but then there's also upfront mortgage insurance. FHA loans do not have a cancellation option with mortgage insurance. And so essentially what we're going to use FHA loans for is for an opportunity to have that entry to homeownership. So as I improve things like maybe credit score or my expense ratios, I'm going to be looking to refinance hopefully into more of a conventional product. FHA is going to be a much more lenient product than what we'll see on a conventional loan. So here's an example. Let's say I had a late payment on a student loan in September of 2024. Well, it might be challenging to get a conventional loan if I've had any type of blemish in my credit history in the last 12 to 24 months, whereas FHA will have a little bit more flexibility for me in that regard. Now, let's look at the breakdown of payment here for us on the FHA side of things. So if I finance the same amount of money, $500,000, I have my upfront mortgage insurance, which is 1.75% of my loan amount. And then I have my upfront or my monthly mortgage insurance, which is 0.55%. So the expense structure is going to be higher on the FHA side. There's no question about it. But it will give a buyer a little bit more flexibility in access to products. Now, one thing before we move on mortgage insurance, if you've already started some of your rate searches, let's say before class, and you're looking at FHA rates versus, say, conventional rates, you're generally going to find FHA rates are a little bit lower than conventional loans. And the reason why that is because the expense structure is much higher in FHA loans when it comes to mortgage insurance. So you may see an FHA loan at 5.75%, but a conventional loan's at 6.25%. That variance is just attributed to the difference in the overall kind of loan structure between an FHA loan and a conventional loan. All right. Okay. So Ken was explained out to the group. I know John had a question about city programs, specifically for assistance programs. We're not going to have time to look at city programs in particular tonight in class, just because obviously there's a lot of different programs out there. But I would encourage you, let's talk offline. We can talk about what city you're looking at. We are going to look at some state programs tonight and some national-based programs as well. Okay. Let's kind of talk a little and turn our attention to income for qualifying for a mortgage. We get a lot of questions around, what income is eligible, what's not. So when we think about income for qualifying and the documentation that we need to provide as a buyer, that's all listed right here. So we kind of give you kind of a glimpse into what we generally will ask for in the documentation. I want to spend some of our time tonight talking a little bit about scenarios for qualifying income, because that's kind of where clients get a little bit confused. So in lending, we always have to verify 2 years of work and/or educational history. And what that means is if I just started my job, let's say in January, but prior to that, let's say I did 4 years at UCR, and now of course I've graduated, I'm in my career, even though I don't have a full 2 years on my job, I can use my undergrad work hypothetically to cover a 2-year work and/or education history. So what some buyers believe is that they need to have 2 years on their job or in the industry to qualify for a mortgage. That's not necessarily the case. And so you can put together a work history with just 2 years of that work and/or education. We also see some cases where, let's say I've been working on my job for 6 years and I have a new job opportunity and that job is going to start 2 months from now and I have an offer letter for that job. Well, we can actually use that offer letter to qualify for our mortgage. So many times people think I have to start on that job and I have to be there for a certain amount of time before I can actually qualify for a mortgage. And that's really not the case. We can actually use an offer letter. In fact, in some cases, you can actually close escrow with as little as an offer letter for your home purchase. Now, in the 2-year rule that comes in lending, if I have, let's say, variable compensation, like let's say bonuses, or maybe a situation where I make overtime, or we see a lot of our clients in the tech industry, especially, they get RSU grants. To use any of those variable sources of income, we are going to see that I've been on my job for at least 2 years to be able to count those into the qualifying. Okay, so that's where that 2-year requirement gets a little bit difficult. Now, also, if I have two different employers I work for, so Let's say I'm working 30 hours for one employer, another 20 hours for another. I have two sources of income. If we want both sources to be counted, then in that case, I have to see that I've been working on both jobs simultaneously for the last 2 years. All right. And then if I'm self-employed, so I file maybe a Schedule C as part of my federal tax returns, or I have an LLC, whatever the case may be. In that case, I do have to show 2 years of tax filings consistently for the last 2 years to be able to use that to count towards qualifying for a mortgage. All right. And then two other things I just want to point out to our class is that if I have a W-2 job, but I also have maybe a side business that I work on, if that side business has 2 years of tax filings and I want to factor that into qualifying, then I just have to, again, show that I've been doing both jobs, that I can handle both jobs for 2 years. And if I have other sources of income, let's say my partner contributes to the household income, but they're choosing not to be a part of the application, then I can't use that additional income unless they want to join us in the application. All right. Okay, so that's a quick look at income. And as we identify income for qualifying, we compare that to expenses that a client has. That include existing expenses like credit cards, personal loans, student loan debt, and also projected mortgage expense with my new house. So for example, if I look at someone and you can see a scenario on screen that someone's paying $8,500 a month that's making $8,500 in pre-tax income, and they have a projected housing expense of $2,500, which would be principal and interest, property taxes, insurance, maybe mortgage insurance, and maybe I'm buying a condo, so that'd be HOA expenses or homeowners association dues, and my total debts are $500. Then that tells us that that client has $3,000 of their expenses or $3,000 of those expenses consume their pre-tax income or 35% of their total pre-tax income. So that's what we call as debt to income ratio. It's a qualifying metric that lenders use to identify eligibility. Now that number can go as high as 50%. Generally, it's right around 40 to 45%. Most buyers feel pretty good, or they feel like they're in the comfort zone of buying when they're around 33 to 36% debt to income ratio. Everybody really has a different tolerance level for what that looks like. But ultimately, as a lender, we're going to measure your expenses versus your pre-tax income. So that's for someone that's a W-2 wage earner. If I'm self-employed, we're going to look at your net income of your business and compare that versus the expenses. Now, that is a metric for qualifying. It doesn't necessarily lend itself to affordability. So as I get a chance to work with you and design your own options around home buying, we're going to talk about affordability. Like, can I afford that $2,500 mortgage payment? Even though my debt to income ratio is 36%, there might be some other expenses that we don't identify or have visibility to. So those are conversations we're going to have as we design affordability options for you. All right. So that's how we see income. Now let's talk a little bit about assets or savings for homeownership. And between credit and savings, that's probably one of the biggest, I guess I wouldn't say hurdles for homeownership, but it's certain things that we need to identify as areas of opportunity. So I want to give you again some quick kind of checklist of items in how we identify assets that can be used in a mortgage or for a home purchase. We generally will identify or validate the last 60 days of assets for you, and we can't use cash deposits in applying for financing, so that's important to know. So everything has to be seasoned. I got this question just yesterday, so I think it's important to bring to class. Cryptocurrency currently is not recognized in financing. So that is unfortunately something that can't be used at this point, but you can use 401ks, 403bs, brokerage accounts can be accessed. I always encourage clients, if you're going to use those type of resources, definitely talk to your financial or tax advisor before you access those type of assets. Gift funds can be also used, and that's where a family member is contributing towards your home purchase. And so there's a way that we kind of document those resources, but it can certainly be used in a home purchase. Now, as we save for home ownership, again, it's probably going to be one of the bigger hurdles for some of our buyers because when we think about home ownership, we have to save up for down payment. We also have to save up for closing costs. And we're going to walk you through some exercises on what that looks like tonight. But let's say I'm in a situation today where I'm maybe renting at $2,000 a month, right? But I think I can save, or I should say, I can be able to pay about $3,500 from a housing perspective, right? So I'm paying $2,000 a month in rent today, but I think I can afford about $3,500 in mortgage. But really today, I just started my job, so I'm kind of don't have a lot of resources today, but I want to save up towards home ownership. What I would encourage our clients to do is let's start saving like we're paying that $3,500 mortgage payment today. So I probably have a great job, I'm making good money, but I just haven't got a chance to save enough. But if I can start paying into my savings account like I'm making that $3,500 mortgage payment, then what I do for myself is I'm adding an additional $1,500 in savings on a monthly basis into really a growth account for myself to prepare for home ownership. So on the first of the month, when I make that $2,000 rent payment, I create that discipline for myself that I put another $1,500 into my savings account. By the end of 6 months, I have $9,000. By the end of 12 months, I have $18,000, not including what I can get in a high yield savings account. So that's a great first step in savings for homeownership. We've in fact have one of our own success stories. We had a client that went through this exact plan 12 months ago. His name's Evan, and he actually just went under contract for his home just 2 days ago. He's buying a home in Northern California, the Bay Area. Started with minimal savings, got himself up to a great nest egg in homeowners or for homeownership, and now in 30 days he's going to be a homeowner. So I would encourage you to try to apply a plan like that. Obviously, you can change the numbers based upon where you're currently at, and we would love obviously to help you through that exercise as well. Now, we had a question about assistance programs offered kind of localized in city programs. Like I mentioned, we're not going to talk about city programs because there's quite a few, but let's talk a little bit about state programs that are available. We are the leading provider of first-time buyer programs through the state across the state. We are partnered with CalHFA, which is the California Housing Finance Agency. It's designed to support low to moderate income households as first-time buyers in California. So I'm going to walk you through a few programs that are available to you that can make homeownership so much more of a near-term goal. Now you can see some of the programs listed here. And for those of you that are familiar with CalHFA, CalHFA got a lot of notoriety in the last 2 to 3 years through a program called Dream for All. You may have heard about it. We had the pleasure of being part of the kind of the builders of that program with our team that created that with CalHFA. That program currently is funding out some of the resources from the last year and a half. We are expecting that program to go live again in 2026. And so we'll have more details on that. Essentially, is a program that provides up to 20% of your sales price or $150,000, whichever is less. So stay tuned for more details on that. The programs that are available today would include the MyHome Assistance Program that provides up to 3% of your sales price in assistance on a conventional loan, 3.5% for an FHA loan. And essentially, those sync up with the minimum down payment requirements for each of those products that we reviewed earlier today. Essentially, what we do with those assistance options, we create a separate loan for you at a 1% simple interest rate. And those assistance funds don't have to be paid back until you either sell your home or if you decide to refinance in the future. All right. Now, in addition to that, there's the My Access program, which provides up to 2.5% of your loan amount in assistance. Now, that's a separate loan, again, at 1% simple interest. No monthly payments are required, similar to the My Home. Does not get paid and back until you either sell the home or if you refinance in the future. All right. And then the My Access program here that you can see in the ZIP program are a little bit interchangeable depending on what makes the most sense for the client. ZIP is 2% of the sales of the loan amount, whereas My Access is 2.5%. But ultimately, those are resources that can help towards your closing costs in purchasing a home. Now, for those of us that are maybe not in California, there's the Pathway program that we have internally, provides up to 5% of the sales price in assistance. There's also some national programs like within Fannie Mae. I also wanted to kind of recognize GSFA. That is California specific. GSFA stands for the Golden State Finance Authority program. So generally that will be an alternative program for some of our clients that may not qualify necessarily in the CalHFA program. Okay, I see your question in the Q&A. Before I get to that, I just want to kind of give you guys an example of CalHFA and how we apply those type of resources in more of in a conventional purchase scenario. So, in a traditional setting, if someone's to buy, let's say, a $500,000 home and puts the minimum down payment of 3% plus closing costs, which we generally tell clients to budget about 2 to 3% of their sales price, someone is probably gonna have to save up about $27,000 to $30,000 for their home purchase. However, if we were qualified under a CalHFA assistance program, and let's say we incorporate the My Home product, that would give us $15,000 in resources to offset my down payment requirement. If I also needed some additional resources, I could participate in maybe My Access or ZIP. That could give us another $12,500 in program assistance. And now instead of having to maybe come up with that huge number of 27 to 30,000, maybe it's a fraction of that. And so that's really how we incorporate assistance programs to help really create better affordable options for first-time buyers. Now, there are some eligibility requirements for CalHFA. There is minimum credit score for each program that they offer. You can see those listed on screen. And there's income qualifications. So the income qualifications are based upon 150% of the median income for your market. Next screen that we kind of slide over to, I'll show you guys what those income limits look like. And a first-time buyer is someone that hasn't purchased in the last 3 years. And these programs are eligible for any type of one-unit property that you're have interest in. It just can't be like an income-producing property, like a 2-unit, 3-unit, or 4-unit property. All right. And then last thing I wanted to point out with eligibility, we look at applicant income when qualifying under the income limits. So if I'm a household of 2 and we both are income earners, but let's say I'm only going to apply with just my income, then if that income keeps us below the income limit, that is absolutely allowed under these programs. And here's what the income limits look like for CalHFA. So depending on what market, we just kind of spotlighted the Southern California markets, but we can put in the chat the link to all counties across the state. But just a great tool to make homeownership so much more of a near-term goal for you. CalHFA just celebrated 50 years of supporting California in affordable homeownership, and we're excited, obviously, to be the #1 partner with CalHFA. All right, so that's a quick look at first-time buyer programs. And like I said, if you want to kind of talk a little bit of any other market programs that you're interested in, love to be able to connect with you offline. Before we get into workflow of buying a house, which is one of the more important parts of tonight's class, I want to just answer the question that came in the chat, which is, if you're going to use money from your individual brokerage account for a down payment and closing costs, how much time with anticipation should you take the money out? Great question. So it depends on where those funds are housed right now. So if they're in secured assets, like they're in stocks or whatnot, I think you got plenty of time to access or sell those assets once you go under contract with the seller. So I know we're going to jump ahead a little bit here, but if we looked at our workflow design here, once you're under contract or in escrow here, that means you have a ratified contract with the seller. That's when I would start selling those assets. And then you can just put those in a cash position, and then we'll kind of walk through the workflow in a little bit more detail in a second, but that's probably what the timing would look like. I missed this in the chat, so I want to just couple questions. So that's my bad here. Question was, is there any specific programs for healthcare workers in California? There is not any specific programs, that are available specifically to healthcare workers. But we do, one thing we'll point out in class later on is that we discount our services for UCR alumni. Okay. And then, can you apply FHA on a foreclosure home? So yeah, absolutely. So a foreclosure home means the lender has essentially taken back that asset because the buyer defaulted. So now the asset is owned by the lender, and you can purchase those homes when they go to market. So absolutely. And then, does the education history need to be continuous to be considered for 2 years of work history? And the answer is no. So we just have to kind of piece together what we've done in the last 2 years. And then generally the education will need to support our field that we're working in today. All right. Thank you for the questions. I appreciate that. And we'll carve out some more time before we wrap up tonight's session. Before we get to the finish line in tonight's class, I want to walk you guys through the workflow of buying a house. So, essentially, where do we go from here after tonight's class? Well, I hope I get a chance to connect with you individually for a consultation. That's a free service we do for our communities. I do those probably about 8 to 10 of those per day, just to help provide guidance in home ownership. Now, as we finish up a consultation with the client, that kind of gets us on now the path towards home ownership, which step 1 is going to be a pre-approval, which essentially tells us, hey, we're eligible for financing. And when we're ready, we can kind of jump into the market and start actively looking at homes. Now, a pre-approval is generally good for 60 days, but we can always recertify it at any time. Your application, when you decide to apply with us, is good for 2 years. So you have plenty of time to do, an adequate search of homes for yourself. Now, as a reminder, when you do your application with us, it is only a soft credit check, so you don't have to worry about your score being impacted. So as we formulate the pre-approval, that's going to move you to step two, which is the home search process. Generally, we'll start online, as many of us know, and then we would encourage you to connect with a realtor in your community that would then help you with the in-person search. We do have a list of preferred realtors that we work with throughout the country in your local market that you want to buy in. So when the time is right and you want an introduction to one of our trusted providers, we're more than happy to get you introduced. Honestly, the house hunting phase probably takes the longest. That's step two. It can be 2 to 3 weeks, can be 2 to 3 months. For a client that actually we just helped close their home today, it took 3 years. So it really just depends. And everybody's at their own kind of timeline of buying, but ultimately, we want to make sure that you have all the support for whatever that timeline looks like for you. Now, if we were to fast forward a little bit, let's say we find a home that we like, we make an offer on the home, and the offer gets accepted. To the question I answered earlier, then we go into contract with the seller. That means entering escrow. Seller has now accepted our offer, and now there's usually a timeline in that contract when we're going to close escrow or get the closing completed. For the most part, in most of the markets, it's a 30-day time period. So to go from step three in this workflow to step six, getting the keys, it's about 30 days. Believe it or not, it can be as short as 14 days, which I know is not ideal, especially for first-time buyers. But in some of the hyper-competitive markets like Santa Clara County or LA or Orange County, we do have to sometimes condense those timelines a bit. Now, when your offer gets accepted, then you're going to get a call from me saying, congratulations, you did it. Your offer is accepted. Let's talk a little bit about next steps, and then let's schedule you for your follow-up video session so we can go through all of the ingredients of your financing. Because at pre-approval, it's kind of just more high level. Let's build a budget. Let's talk about your plan. But now once we have an agreement with the seller, then we have real-time numbers to work with, and we want to make sure the design is appropriate for you. Now, you will also have other action items that you'll do once you're under contract with the seller, like getting your deposit in, which is usually 1% to 2% of your purchase price. That is a amount of money that gets held in escrow for you while you go through the buying process. Now, that money does count towards your out-of-pocket expense towards purchasing a home. And that money, again, is protected in escrow because you as a buyer have protections in your contract for the most part, as long as you've elected these, and they're called contingencies, which essentially allows you to get your house appraised to make sure it's worth what you're buying it for, to get the house inspected to make sure there's no issues that could be problematic for you, and to get your loan approved. For most contingencies, it's going to be anywhere from 7 days, short of 7 days, to as long as 17 days in the contract period. So again, that does protect your deposit while you're going through your research and you're under contract with the seller. Now, as we move through these milestones, you can see step 4, that's more of the administrative functions of the loan. We're going to process your loan. We're going to validate employment, assets. We're going to make sure your program is structured correctly. Now, one of the questions that comes up a lot from clients is interest rates. Now, what happens with my interest rate? Well, once we go under contract with the seller, then we're strategically watching the market to try to time interest rates because interest rates can fluctuate daily. We learned a little bit about interest rates earlier today, but especially with things being very volatile and, depending on what the Federal Reserve does on certain data points that come in, we're going to be watching to try to time the market as best as possible for you. That's one of the things we add as value to our clients is we really understand the market flow, and we're trying to really time things as best as possible. As we continue to move through the workflow, step 5 is going to be the approval process for your loan. That means an underwriter has approved your loan and validated everything, make sure everything checks the boxes for the program that you're selecting. Now, as we move through these different milestones, you're going to be getting e-signature disclosures sent to you that highlight all of the elements of your financing. So there's no surprises along the way. There's initial disclosures within 72 hours of your accepted offer. There's a set of revised disclosures that come out once your interest rate is locked. And then 3 days prior to your closing of your home loan, you get a final closing disclosure that basically trues up or kind of balances out all the numbers to make sure everything is in line for your upcoming closing. And that is step 6 in the process. That's where you'll sign final loan documents with a public notary. That takes about an hour or so for that process. That same day, you'll wire in final funds for your home purchase. And as your lender of choice, we'll also wire in the funds for your financing, especially any assistance programs that you've elected. And then the escrow team will take those funds, make sure everything is accounted for, and then record documents with the local county recorder's office. They'll record a grant deed to transfer ownership. They'll also record a deed for the mortgage financing that you're essentially electing. And once that's all confirmed as recording, then we get a chance to make our favorite call of the day. And I got a chance to make a few of those today, is to say, hey, congratulations, high five, you're a homeowner, you did it. You're now across the finish line. Time to go get the keys and start moving. It's a huge accomplishment. Best part of my day by far is to be able to make that call because it truly is a huge financial milestone for our buyers. And our relationships though don't stop from there. As part of our aftercare with our clients, once you get your keys, you're moved in, you're settled in, we're always staying connected with you through our rate watch notification system. So if you're buying today in today's market where rates are a little bit higher, when it makes sense to refinance, we're going to make sure we stay connected to have those conversations. We're going to have you tracked in our HomeBot system so you can track your home equity, see what's happening with, appreciation rates in your neighborhood, and always checking in with you to see what's going on financially, at least on an annual basis. All right. So that's kind of what the process looks like. Now, if you're thinking about maybe taking the next steps in home ownership, whether it's a goal for 2025, which that might be a little ambitious because we only have a few months left, but if it's something you want to plan for in 2026, or beyond, we'd love to be able to partner with you on that journey towards homeownership. You can do so by filling out this get started information here. We've talked a little bit about it tonight. Online application. We do a soft credit check. You'll upload documents, and then we'll do a virtual session together. You can schedule that session by booking your appointment here. If you have follow-up questions after tonight's class, we have plenty of time because we're not quite to the top of the hour. We'll take some questions tonight, but you can also schedule an introductory call also on our scheduling site. All right, and I just want to kind of share with you, this is what a consultation looks like. So it's different than what you'll see from most lenders because we're diving deeper into budget analysis. We're doing that rent versus buying calculator. We're talking about affordability. We're going to build a plan that's comprehensive and really helps support you in your goals of home ownership. And as we wrap up tonight's session, I just want to share with you some of our technology too. We really embrace technology. Certainly does not replace the human touch side of the business because we want to stay connected with you, whether it's phone calls, emails, text messages, whatever the case may be. But our mobile tool is a great way of staying connected with us too. It'll push notifications on progress for you. You can do calculations there. You can even start your application. We also embrace AI technology through some of our response systems too as well. So, we certainly understand technology is a part of home buying, but we want to make sure that you understand the human element as well too. And finally, part of our partnership with UCR includes our discount. So we actually discount our services for those that choose to purchase or refinance with us. Of course, you have access to these free classes that you get on a quarterly basis that we would love to share with others in our community. And we have other classes that we teach throughout the country. So if you like what you've heard, definitely share this with friends, family, and some coworkers. We'd love to have them be a part of upcoming classes. We still have a few classes left for this year, actually more than a few. I think we're probably teaching at least 10 to 15 classes for the balance of 2025. All right. And finally, this is all my contact information. So if you want to get connected with me, feel free to just reach out to me. And, we do have a lot of our clients that share their experiences with us. Fellow alumni that right from UCR that have purchased homes with us over the last several years. We love what people say about us in our community on either reviews or what they're saying about us in Reddit, or just posts on Instagram that they're sharing about their experiences and getting the keys to their house. That means the world to us for sure. All right, well, that gives us to the end of class. I have some questions that are kind of stacking up on me, so I'm going to answer some questions. I encourage you to stick around with us. We'll get those questions answered on air, and we'll stay as long as we need to. So let's dive in. One question in the chat was, what are some scams people should know and how to avoid it? Well, if you're talking specifically housing scams, you just in general, like anything in this world, you got to be very careful on what gets into your email. I mean, I think the scams I see generally are just unrealistic interest rates that are out there. You see a lot of click scams, especially on sites showing ridiculous 4.5% interest rates that don't exist. So I think you just got to be mindful of that. And as a trusted mortgage advisor, we're going to share transparently what it looks like, right? And there's no smoke and mirrors out there. It's really the true transparency that I think is important. So there's a lot of that kind of deceptive practices, unfortunately, that go on in the industry. Can you share the appointment link? We did that. Will the credit check have any impact on our credit score? No. So that's the part of why we do a soft credit check, because it does not impact your credit score. And then, yes, this is recorded, so you guys can listen back to this video. This will be up on our YouTube channel. Ken from our team is going to be sending out all of the slideshow. We had quite a few that signed up for tonight's class. We had over 200 people sign up for our class, so we're going to get that out to them as well as the link to the YouTube channel. And then I think there was one other question, but maybe Ken took it. Um, Let me answer this question just for the group. So if you're planning to buy a home with your siblings and combine everyone's income, who will need to apply to the FHA loan? So if you do want the income for all of your siblings included, then everyone would apply to the mortgage. All right. And I think in terms of any downsides to that, I think let's talk through that. That's probably more of a one-on-one conversation because if we're going to try to incorporate assistance programs or anything like that, we just want to kind of maybe just talk through it to make sure we don't impact us maybe going over the income limit eligibility. Okay. Great questions, guys. I appreciate the engagement in class. What other questions do we have before we wrap up tonight's session? I think I saw a hand raised, but I think that just might have been inadvertent. But if you do have any questions, feel free to drop that in. And I think just to kind of, I guess, wrap us up, I mean, I do think, starting here in a resource class like this will hopefully help kind of get things processing for you in homeownership. Homeownership truly is a huge accomplishment for you financially. It is an asset that can work for you. Just ask all the hundreds of clients that we've helped with over time that have been a chance to have the opportunity of homeownership and see that growth in equity. It's a huge, huge opportunity for you. So encourage you to really consider that as you take those next steps financially for yourselves. Sorry, I got a couple more questions that dropped in, so I'm going to answer these too. Do you know of any other job-specific assistance programs? So there really isn't any job-specific assistance program. Some parts of the country, if you're in your first responder, will do different programs. California doesn't have anything specifically, unfortunately. But if you're outside of California, we can certainly talk about that. What are some easy things to do to positively impact your credit score? So I would say take a look back at some of the stuff we covered in the credit section. Some kind of the low hanging fruit opportunities that maybe credit utilization is generally driving down credit card debt is usually the easiest one. And of course, avoiding like opening new credit accounts, that's usually kind of the big hits. But and we can certainly identify opportunities for you specifically if you want to have a one-on-one with us. And then if you're planning to buy your first investment property but rent it out, Airbnb, can you apply to the FHA loan for that? So unfortunately, no. FHA is only owner occupied. So if you want to purchase an investment property, and it's going to be non-owner occupied, you at least have to put 20% down as a conventional loan. Now you can do an FHA loan for a multifamily, so meaning a 2-unit. Let's say I'm going to buy a duplex and I'm going to rent one unit out. I'm going to live in the other one and be owner occupied. That could qualify under FHA, but I can't be a non-owner occupant on both units and use FHA. It would have to be a 20% down conventional loan. All right. Okay. All right, team. Well, I think we did it. I think we got to the finish line. You guys have been an awesome class. Hope we get a chance to meet with you at some point in time. Hope you guys have a great rest of your Thursday night. Have a great rest of the week. And I'll look forward to talking to you soon. Have a wonderful evening. Good night.